Hi, I'm Mark King, Head of Content for EMEA at Columbia Threadneedle Investments. Joining me for this episode of Eye of the Needle is William Davies, Deputy Global Chief Investment Officer and Chief Investment Officer EMEA. And we're going to be discussing the outlook for 2022 across monetary and fiscal policy, companies and markets. Will, let's start with how you see the monetary and fiscal policy environment changing in 2022.
The monetary and fiscal environment is going to change considerably in 2022. If we look back to 20 and 21, and we're going through the pandemic, we've seen very lax monetary policy and very stimulative fiscal policy as well, not only in the US, but around the world. As we move into 2022, that is going to change. We expect interest rates to rise as we go through 2022. Indeed, we've seen the start of that already at the back end of 2021. And so as we go through 22, there'll be a completely different monetary environment. But this has been anticipated within markets, so it's not as if it's going to be a surprise, but nonetheless, it will be a changing environment as we go through 22. Similarly, with regard to the fiscal environment, in terms of the fiscal stimulus, we've seen emergency packages which have been announced in 20, implemented in 21, will continue as we go through 22. However, in terms of that stimulus, we expect that to get less as we move through 22 and 23. So consequently, the effect of that fiscal stimulus is not going to be as strong in 22 and 23 as it has been in the recent past. So the overall environment is going to be very different as we go through 22 and 23 as it has been in 20 and 21.
How do you see inflation changing in 2022?
Inflation has been one of the surprises in 2021. It's not a surprise that inflation rose. That is what we expected. However, the degree to which inflation rose was greater than we had anticipated, rising to around 5% within the Eurozone, over 6% within the US. That was not what was expected at the beginning of 21. Also, the longevity of that inflation is going to be greater than we had anticipated at the beginning of 21 also. That is driving the increase in interest rates, which we're expecting in 2022, and has been brought forward from what had previously been expected. However, as we go through 22 and we start to see the unwinding of some of those supply chain blockages, we do expect to see inflation fall. We don't expect inflation by the end of 22 to fall back down to the 2% and below levels, but we do expect to see it fall down towards those particular levels. And in terms of seeing the change in inflation and the fall in inflation, that is going to be really important for markets as we go through 2022.
It's quite clear that supply chain delays caused some headwinds in 2021. Do you see that moderating in 2022?
The supply chain concerns over, well, I guess a little bit 2020, but increasingly in 2021, have helped drive inflation higher and have disrupted the supply of certain goods within the manufacturing sector in particular. Part of that is brought about by the pandemic. It's brought about by problems with unemployment or employment. And as we go into 2022, we would expect as the pandemic starts to ease, that we will start to see those supply chain problems easing. In fact, we've started to see some of those occur already at the back end of 21, but don't get me wrong, those issues are still there. But as we go into 2022, we expect time to start easing some of those pressures.
So where does all this leave corporate balance sheets then, Will?
One of the things which has been apparent during the pandemic is that as we've seen recovery, corporate earnings have been stronger than we would have anticipated. Corporate balance sheets, as a result, are also very strong. So in terms of the corporate sector, liquidity, balance sheets are looking in pretty good shape as we go through 2022. Indeed, within credit, there are a number of companies which in 20 and 21 moved out of investment grade and into high yield. We expect to see the opposite in 22, as some of those companies which have fallen into high yield will move back into investment grade. And so you'll see the rising stars being apparent around the credit markets.
Okay, I'm going to move on to a more difficult question perhaps. What's your broad expectations for equity and fixed income markets in 2022?
In 2022, we still believe that equity markets and credit markets will see positive returns. However, what we do not expect is that those positive returns are going to be nearly as high as those returns we saw in 2021. Why is that? Well, we continue to believe that we will see corporate earnings growth as we go through 2022. We will continue to see economic growth, although that economic growth is likely to be lower in 22 than it was in 21. As a result of that, we think there is support for equity markets, and indeed within credit markets, if we look at the strength of those balance sheets and we look at a slowing economy, but actually an economy which is still growing, we believe that the outlook for companies is still relatively bright. However, the valuation, particularly within equities, has gone to higher levels than it was earlier in anticipation of some of this growth that we expect in 22 and beyond. And so because of that, we continue to expect growth, but that growth is likely to be lower than the growth we saw in equity markets, at least in 2021.
Okay, that's equities, but what about fixed income?
For fixed income, within credit, we expect to see positive returns. Within sovereign, it's going to be a little bit more difficult as we see pressure on yields, probably taking yields a little bit higher as we go through 2022. So we don't necessarily see dramatic moves in terms of yields in 22. However, it's going to be difficult to see the positive returns within sovereign markets.
So is this an environment where you see companies at the quality end of the spectrum being more resilient?
If we look at quality companies and the performance of quality companies over recent years, we've seen periods when those types of companies have outperformed meaningfully. We would look at 2019, the very beginning of 2020. We would look at the back end of 2020 and the beginning of 2021 when the opposite occurred, when the more economy sensitive, when those value companies started to outperform. If we look at 2022, it's going to be a slightly different story because we've got a slowing economy, but still profits growth. We see interest rates rising, but equity markets, credit markets, are predictors of what is going to happen and not an indicator of what has just happened. And so markets will be looking at what is going to occur at the back end of 22 and as we go into 23. We would look at an environment with inflation starting to fall around that period of time. Interest rates rising immediately, but then plateauing at some stage. An environment like that is one which should be positive for quality companies which are in control of their own destiny, drive their own top line revenues and profits growth. In an environment like that, not that dissimilar to the 2010s, ought to be positive for the quality areas of the market. So as we look out into the future, we think we can see attractive opportunities within these types of companies, but it may well be that the difference between the quality companies and the economy sensitive or the value type of companies is going to be less discernible in 22 than it has been in various periods in the recent past.
If you could put your global hat on now, Will, can you speak to the relative opportunity among regions and where do you see the greatest opportunity?
I think it's quite interesting to look at what has happened in 2021. We've seen really strong performance in US equity markets, strong performance across Europe. Within emerging markets, less so. As we move forward, we expect to see structural growth within emerging markets. We continue to see profits growth within emerging markets, yet the valuations, given the underperformance in 2021, is actually making some of these regions look quite attractive. So as we look forward, we do see positive returns within equity markets. We see positive returns within credit markets, but we think particularly within equities, within emerging markets, there are particular opportunities and particularly attractive areas to invest as we move forward through 22 and 23.
You mentioned EM there, but can you give us a few extra thoughts on China in 2022?
Well, China is quite an interesting market and economy. China is where the pandemic started, but also was controlled very well very early on. The Chinese economy actually grew in 2020 and has continued to grow in 21. There's been less fiscal stimulus there as a result. There has been less loose monetary policy within China as a result. For the market as well, the market has underperformed as we've gone through 21. Now, that's not only because of the fiscal and monetary policy, it's also because of a stricter regulatory regime within China as well. As we move forward, we think the valuations are starting to look quite attractive within China. And so if we look at China, we see opportunities for investment. But be careful, it's not in all sectors, because some of the business models have been really threatened by some of that regulatory change within China. What you need to do as a company is to align yourself with the aims of the authorities, of the government. If you can do that, then I think there are real opportunities within China because the sell-off has been across much of the market.
I think it'd be remiss of us not to talk about responsible investment while you're here. It's hugely important to us at Columbia Threadneedle Investments, but do you see it gaining even more prominence, both in what we do and externally?
Responsible investment is key to what we do here at Columbia Threadneedle Investments. It's not only the right thing to do, but if we look at companies, if we look at net carbon zero initiatives, responsible investment, environmental, social and governance factors are driving the allocation of capital by companies. When we see companies' actions affected by ESG, it's really important for us as investors to have a firm view, a firm conviction around how that is going to drive returns, how it is going to drive revenues and profitability for those companies in which we invest or indeed in which we will divest from. Hence, the challenge to those business models or the opportunities to those business models, which is brought about by this changing environment, is critical when we are undertaking our research. As such, ESG factors are at the center of our research process, at the center of our investment process, and will continue to be really important as we move forward in coming years.
And finally, Will, why will it be important to take an active approach in 2022?
I think as we've gone through the pandemic, we've seen the ups and downs in terms of economies, in terms of markets, in terms of sectors, in terms of people's expectations of what will drive the future economies and indeed the returns of companies within that. As we see these changes, whenever you see change, it gives an opportunity for active investors. So we at Columbia Threadneedle Investments, as active investors, are well positioned to take advantage of these changes as we go through 22 and through 23. Change drives the opportunities for active investors, and we continue to anticipate change as we go through the coming years. Hence, critical to have the active investment approach.
Thanks very much, Will. Great to hear your thoughts on 2022. That's it for this episode of Eye of the Needle. We'll see you next time.
Important information. This is an advertisement. This podcast is intended for informational purposes only and should not be considered representative of any particular investment. This should not be considered an offer or solicitation to buy or sell any securities or other financial instruments, or to provide investment advice or services. Investing involves risk, including the risk of loss of principal. Your capital is at risk. Market risk may affect a single issuer, sector of the economy, industry, or the market as a whole. The views expressed are as of the date given, may change as market or other conditions change, and may differ from views expressed by other Columbia Threadneedle Investments associates or affiliates. This information is not intended to provide investment advice and does not take into consideration individual investor circumstances. Investment decisions should always be made based on an investor's specific financial needs, objectives, goals, time horizon, and risk tolerance. Asset classes described may not be suitable for all investors. Past performance does not guarantee future results, and no forecast should be considered a guarantee either. Information and opinions provided by third parties have been obtained from sources believed to be reliable, but accuracy and completeness cannot be guaranteed. This podcast has not been reviewed by any regulatory authority. In the USA, Columbia Management Investment Advisors, LLC, CMIA, is an investment advisor registered with the US Securities and Exchange Commission. In Australia, issued by Threadneedle Investments Singapore Pte. Limited, TIS, ARBN number 600 027 414. TIS is exempt from the requirement to hold an Australian financial services licence under the Corporations Act and relies on Class Order 03/1102 in marketing and providing financial services to Australian wholesale clients as defined in Section 761G of the Corporations Act 2001. TIS is regulated in Singapore, registration number 2011015559W, by the Monetary Authority of Singapore under the Securities and Futures Act, Chapter 289, which differ from Australian laws. In Singapore, issued by Threadneedle Investments Singapore Pte. Limited, 3 Killiney Road, 07-07, Winsland House, 1, Singapore 239519, which is regulated in Singapore by the Monetary Authority of Singapore under the Securities and Futures Act, Chapter 289. Registration number 2011015559W. This advertisement has not been reviewed by the Monetary Authority of Singapore. In Hong Kong, issued by Threadneedle Portfolio Services Hong Kong Limited, Unit 3004, 2 Exchange Square, 8 Connaught Place, Hong Kong, which is licensed by the Securities and Futures Commission, the SFC, to conduct Type 1 regulated activities, CE AQA 779, registered in Hong Kong under the Companies Ordinance, Chapter 622, number 1173058. In the USA, Columbia Management Investment Advisors, LLC, CMIA, is an investment advisor registered with the US Securities and Exchange Commission. In the UK, issued by Threadneedle Asset Management Limited, registered in England and Wales, registered number 573204, Cannon Place, 78 Cannon Street, London, EC4N 6AG, United Kingdom. Authorised and regulated in the UK by the Financial Conduct Authority. In the EEA, issued by Threadneedle Management Luxembourg, SA, registered with the Registre de Commerce et de Société Luxembourg, registered number B110242, 44 Rue de la Vallée, L-2661, Luxembourg, Grand Duchy of Luxembourg. For investors in the Middle East, this podcast is distributed by Columbia Threadneedle Investments, ME Limited, which is regulated by the Dubai Financial Services Authority, the DFSA. The information in this podcast is not intended as financial advice and is only intended for persons with appropriate investment knowledge who meet the regulatory criteria to be classified as a professional client or market counterparty, and no other person should act upon it. Columbia Threadneedle Investments is the global brand name of the Columbia and Threadneedle Group of companies. ColumbiaThreadneedle.com.